one of your overarching themes is consumer protection. And so I would really like your views on the state of consumer protection within financial services, and how do you think FSRA is doing? And I assume your answer is going to be some version of great, but in that context, how do you measure your progress then?
Well, I'm probably too modest to say that we're doing great, but we are doing tremendous things for the consumers in Ontario. Consumers need someone to actually level the playing field. Financial services, the products, they can be complex. And it's a complicated ecosystem of how they have to consume these things and are essential to every element of their life. When you think of it, from buying a car, having a house, saving for a pension, having banking services, getting investment advice. And so that's what we aim to do. And so we have been in business about 3.5 years now, and I am very pleased with the progress. In the words of someone said recently, we are a work in progress, and we are accelerating our efforts, and we'll continue to do that. And the proof really, though, is in the pudding. And when I look at not just the things, and Joanne mentioned some of them that we've achieved in the time that we've been operational, I also look at it in the outcomes that we're getting for consumers. And I see a real difference in what is going on in financial services today. And we're getting discipline, and it's not just the regulator plays its role well, then the regulated entities also help to achieve those objectives. And so as much as, we're not there yet, and frankly, we may never be there. It is a work, because as we evolve, the products and services evolve. And so I expect that to continue. But yes, I am very pleased with what we've got done today.
Okay, and more on the specifics. I've got some more questions there in a few minutes. But I guess one of the issues in relation to consumer protection is what I see as fragmentation of regulation and fragmentation of kind of regulators across Canada. There are so many federal and provincial territorial regulators in relation to financial services. And again, within your umbrella, you regulate so many different sectors. How, what is FSRA doing in this regard in terms of trying to make regulatory harmonization a priority and a reality in Canada?
Well, regulatory harmonization is very important to us. It is in our objects, and we care about our statutory objects deeply. But it matters because consumers will be better protected if we have harmonized schemes, because many of the organizations that provide the financial services and products operate across boundaries. And if they're going to do that effectively, it's easier if they have consistent rules, because it's very difficult to develop products and services for a national business that are different in different jurisdictions. And so the important thing is you want to get it so that the consumers are going to be well protected, and never let the perfect be the enemy of the good. It is somewhat of a mixed bag, I would say. Prudential regulation tends to be fairly well developed and quite harmonized. Consumer regulation, it depends on the particular sector, because it's different for mortgage brokers or for insurance, be it auto or life and health or other P&C, or financial advisors, financial planners, pensions. They all tend to have their own nuances. And I would say conduct regulation in particular is more of a work in progress than prudential. And I think you're seeing that around the world. That since the global financial crisis, where there were tremendous reforms put in place so that safety and soundness is less of an issue, the focus is increasingly on conduct. And it is because we realize, as regulators, governments, policymakers realize, that consumers are dramatically affected by how they consume these products and services. And as I said earlier, they need someone in their corner to make sure that the system is fair.
Okay, understood. In terms of harmonization, kind of different frameworks for different types of regulation and different kind of aspects of financial services. Let's go specifically into insurance, so both property and casualty and auto insurance. Now, at last year's exchange, which I wasn't at, but had a chance to kind of take a look at the online recordings, FSRA had issued a take all comers guidance, which was intended to prevent activities that preclude or frustrate consumer efforts to purchase or renew their auto insurance when they would otherwise qualify for a quote or renewal. And tell me if I've misstated something. And so FSRA announced a thematic review, if I'm correct. And so 1 year later, what progress have you made, and what has changed for consumers, and when can they expect real change?
They have real change. Right now, after the work that we've done, and it took a while because this is a complicated issue, of how distribution systems work within auto insurance. Some are direct, maybe online, some are indirect through brokers. And so there was an issue that every insurer is obligated who has approved rates to give a quote to customers that fit within that criteria. And what was happening is people were not getting quotes. And this is a hidden harm because a consumer doesn't really know why they have to call a 1-800 number instead of getting an online quote. Or they don't know why the broker only offers them 3 quotes when actually that broker represents 5 insurers. And so it was a hidden harm and they were not getting the lowest price. We're comfortable that from the actions we've taken, we put out guidance, we clarified, we've been active from a supervisory front, and importantly, we required all significant insurers in Ontario, right from the senior levels of those organizations, using their own controls, internal audit processes to review their practices in line with our new guidance, which were very clear that they had to provide quotes to all qualifying consumers. No more hidden, not letting everybody get their price. Because sometimes insurers just go, our book is becoming unbalanced. We're getting too much business from a certain profile. Well, unfortunately, that's the rules, is they have to provide those quotes. And so consumers are getting that benefit, and people are concerned about the cost of insurance. I understand that. I'm an auto insurance consumer as well. The number one protection is to shop around and to make sure you are getting the best quote available. And with the Take All Comers initiatives we've taken, I'm comfortable that they are getting those quotes. And we're also still looking at whether, in fact, there are some enforcement actions to be taken as a result of the issues we found.
Okay, I want to follow up on this because I know it's an important point for so many. There's also talk about the role that postal codes play in setting auto insurance rates. The Premier and the Minister have both said that they want to fix this problem as it's an issue of fairness for consumers in Ontario. The Auditor General has said that FSRA's territorial framework results in individuals paying quite widely different insurance rates based on where they live. And so from what I have seen in the public domain, FSRA is reviewing this matter, but what does that actually mean? And what are you doing about this?
Well, we have to make sure that rates are just and reasonable, not excessive. And that's essentially fair to all the consumers.
On veut s'assurer que les taux sont justes.
Good, I didn't call a friend. Okay, so my friend has let me continue on. But it's about making sure that rates are fair. And this, you have to realize, is a zero-sum game. So as much as, yes, the territorial rating system that we have right now in Ontario is in need of review. We inherited that from a predecessor regulator, and it is postal code territory based, and it has certain rigidities that we don't believe make sense anymore. We put out some preliminary guidance. We have one of the best actuarial firms in the world working on it with us, and people can go to our website and see what we put out last December. The truth is that you also have to be fair, not just to the consumers in a jurisdiction that has higher rates because of a certain characteristic of that area, because it's a zero-sum game. Those costs are going to be shared by others. And you want rates to be accurate. And so as much as there may be an unfairness that somebody moves across the street and goes from one territory to another, and they have exactly the same driving patterns in car and really the same, traffic risk, if you will, and risk of theft. So that's unfair. But the truth is, those are soundly based. There is a robust process. Insurers try and do a good job on this, and we hold them to it, that they have good data, they have good actuarial science behind what they're doing. So we need to find the balance of removing the rigidity of what we have in the existing postal code rating-based territories, while still making sure that the rates are as fair as they can be. And so, that is a careful balancing act, because where you live is an important driver, because most accidents happen nearby where you are. And if you live in an area with congested roadways, you are going to be a higher risk. And so there are other techniques which I would urge consumers to think about, like user-based insurance. And so there still may be a territory aspect to that, but it's more about how you drive. And so we understand that consumers want to be treated fairly, and we understand that the territory regime is in need of review, and we're doing that now.
Okay, so more on that. When I look at kind of comparative rates for auto insurance. Ontario is still really, really high, kind of in absolute terms, apart from kind of the fairness issue that we just talked about. The Auditor General noted that between, I think, 2017 and 2021, the average premium in Ontario increased by almost 14%, which is double the rate of inflation. And if I have this right, FSRA approves rate increases. So how do you justify these approvals when 14% is so much more than inflation and so much more than kind of the income coming into ordinary Ontarians?
The rates are always under constant scrutiny by us, and when there's changes and even when there aren't. And so we do work on benchmarking. So I am confident that the rates that we approve are just and reasonable and not excessive, which is the statutory standard. The point about the 14% increase over that 5-year period, I would note that it doesn't take into account the large part of the $1.8 billion that the government and FSRA worked with industry to give back to consumers through rebates, rate reductions, and other tools during the crisis. Because the way rates are set, you get your rate set, and it's for the next 12 months, for example, you get the benefit. So a lot of that is actually coming in 2022. So our rates in Ontario, and those benefits for the pandemic that consumers got in Ontario, they stack up well, not just across Canada, but across North America. So I think that there is a real commitment. We want to have a market that competes for the business. And so high rates, you want the market to punish someone if they're out of line because their costs are too high, so their rates are too high. And so we're working, and the team has really done a good job on working to refine our rate setting processes, including putting in the emergency rate reductions. That was a new process we put in the pandemic so that rates could come down. So rates are higher than inflation, though, in certain years. That is a fact of life. You have to look at what's happening with auto costs, what's happening with repairs, the frequency and severity of accidents, and the amount of fraud and theft in our economy. And so all those things mean that, yes, auto rates can go up over general inflation, and that's not a wrong thing because costs related to automobiles and insuring them are going up above inflation.
Okay, thank you. And we have a panel on insurance later in the day, indeed, so there'll be more on that. Let's turn to credit unions, which obviously is another important sector that FSRA regulates. And Pace Credit Union was placed into administration because of significant governance failings that I had a chance to take a look at. And it resulted in losses to members and eventually the sale of the credit union. And so what has FSRA learned as a result of the Pace situation?
Well, to be clear, there were no losses to insured depositors, and there were no losses to any depositors in Pace. Pace was a successful resolution, and that those close to 50,000 members moved to a merger with a new credit union and are being warmly part of the credit union community in a new legal form. So that's the good news. The bad news is that there were governance failings came right from the top of the Pace organization, and we have taken steps so that I can say that those governance failings will not be repeated at another credit union. We've put in place new supervisory processes, new rules, new guidance, new teams, new data that we're collecting, and we are focusing on not the details within a credit union, but the overall how it operates, its governance, its leadership, its controls, its processes. And so we will make sure that, while I can't say that there'll never be another credit union that gets in trouble because they have to take risk, and it has to be, and that's right in the statute, it's important that they balance risk and reward, but taking risk is very important, but it won't be for the reasons that happened at Pace. And so we've learned from that, and we've actually brought in an external consultant to help us assess what went wrong. And of course, FSRA inherited this because the Pace administration began before FSRA was in operation. But we've gone back and we've looked at the root causes. And so we actually have a process in place to address those root causes, and that risk-based supervisory framework I talked about. I'm comfortable that Pace will not happen again, and that the credit union system is stronger because of it.
Okay, and is this risk-based supervisory framework, is this really kind of direction and setting out expectations to the boards of credit unions as well as the senior management team. The Auditor General, has said that FSRA's inspection of credit unions are not as thorough and not as frequent and lack the follow-up. Are these the changes you're talking about, or is there more to be kind of more expected in the coming months?
Yeah, it's a great question, Poonam. So the Auditor General, for example, looks at activity levels. And what we realize is with the complexity and the diversity within the credit union system, where you have very large credit unions now in tens of billions of dollars of assets, providing the full range of products that you could find at any financial service provider or bank, right down to community-based credit unions that are very focused on traditional, residential mortgage lending and serving a small community. And so we've realized that we have to have a framework that works in that flexible way and allows those different credit unions. We're not picking winners or losers of business models. We're allowing them to serve their members because they're a cooperative organization. And to do that, you have to give them the flexibility to make decisions about good risk management rather than prescribing what are the requirements for risk management. And that begins with governance at the top of the organization, senior management, the control processes. And so we're focused on those things. And because if you're principles-based and outcomes-focused, we're looking for outcomes of a safe, secure, sound credit union, but one that also serves its members. You want to make sure that they're getting their members the financing that they need so that they can buy that house or get that car or have their children educated. And so that careful balancing act, we're going to make sure that the credit unions have the processes and the principles and the governance in place to make that balancing effective so that people get the financial services they need from credit unions. And we're comfortable that we're on the right track in doing that.
Okay, so then what about the deposit insurance reserve fund that protects kind of those deposits that are at Ontario credit unions and Caisse Populaires? The Auditor General, said that this fund is currently funded below your targets. And so isn't that a risk to depositors? And what are you doing about it, or what do you plan to do about it?
So the Deposit Insurance Reserve Fund is an important aspect of safety and soundness. People who put their money in a credit union need to know that it's safe. And I'm telling you that yes, your insured deposits are safe within credit unions. The risks within the system in the credit unions are acceptable risks. The size of the DIRF is about $400 million, and that's about 80% of our target. So it is actually within a relevant range. And it is both funded in advance, and if necessary, credit unions would fund it after the fact. So even if we needed to get to that full $500 million instead of the $400 million, that could be funded after the fact. So I'm not really concerned about the size of the Deposit Insurance Reserve Fund in a sense versus the 100 basis point target. What I am concerned about is that diversity in credit unions I talked about before. And we're having to bring new techniques to assess the adequacy of the Deposit Insurance Reserve Fund, using modern advanced modeling techniques. And we're getting information from credit unions now, which is granular, where we can actually look at the individual loans that they have, and we can essentially run a stress test of what happens within those credit unions and within the 60 or so credit unions as an aggregated group and look at the risks. And so the deposit, we're still advancing that, and it'll be another year before I'm really comfortable with getting into the details on that. But that will give us the knowledge as to whether the size of the Deposit Insurance Reserve Fund is the right size or not from a solvency point of view. So I think we have exactly the right things in process, and I'm comfortable that people can feel that their deposits are safe at credit unions.
Okay, so we'll definitely follow that. Let's turn from auto insurance to credit unions to now life and health insurance, which again another area that you regulate and another important one. So in 2021, you reviewed the distribution practices of life and health managing general agents, and I'll call them MGAs. So in 2022, you focused on a group of MGAs that used a tiered recruitment model, and you went the extra step to do a thematic review of 3 in particular. And my notes that I pulled out, so Experior Financial, Greatway, and World Financial. And then you served one of them with a notice of proceeding. And so from what I have seen, you found some pretty serious issues. Could you explain, I think, to those who may not be as familiar, what they were?
This was an egregious instance of consumer harm. The managing general agents in question, and there were 3, you mentioned Greatway, where we've actually taken successful enforcement action to date. We're running, people have different phrases, a tiered agent recruiting or a multi-level marketing scheme, where they would recruit, and there could be 8, 9, 10 levels of agents. And the new agents would come in, and they'd come in with a client list, generally in a community that was potentially not that well served, generally not high income, and not that educated in financial services products. And they were then using those client lists to essentially generate high fees by selling relatively complex life insurance products, which were unsuitable to those consumers, and which were being sold as an investment product when they were primarily intended to be an insurance product. And there's a very high lapse rate, which means that after a few years of paying high fees, they would collapse. The consumer would go, I need the money, this isn't really, and there would be very little savings there. And they were doing all this because it generated those high fees in this tiered structure where multiple levels of agents were all clipping a coupon without actually servicing the customer. And the MGAs involved, some of them had practices where they actively trained the agents not to talk about the risks, not to talk about it as insurance, to sell it as a savings vehicle. So egregious is the word that I use for this. And so I am pleased that we got to the bottom of this. And this is a significant instance of consumer harm. It is, I will say, limited to essentially 3 MGAs that we've identified and a couple of insurers that supported them. So the vast majority of the life and health insurers and distributors don't follow these practices and are not trying to use this multi-level marketing and sell unsuitable products. But we have to root out where we see this type of harm.
Now, is this an area with these MGAs where you feel that you have the tools as a regulatory body to protect the public, or do you feel that you need additional legislative or kind of enforcement or compliance tools at your disposal?
It's a mixed bag. We do have the tools. We've shown that we could get the information, we get to the investigation. We did it in a rather unique cooperative supervisory model where we actually got the other regulators in Canada, insurance regulators, so the Canadian Council of Insurance Regulators, and FSRA led it. And so we were able to get to the bottom of this, and we are able to take sanctions around suitability and whether the right processes were in place. And frankly, there's more to come on that too, because we've taken one enforcement action, and I'm not sure that this is going to be the end of it. But those are general tools in a insurance distribution regime that does not contemplate the role of these managing general agents. The existing regime, going right back to the Insurance Act, thinks of insurers and agents in a very simplistic way, more the model of an insurer who hires a single agent. And these MGAs have taken on very large presences in the distribution channel. They actually control the majority of the distribution of certain products. And so there is a concern about whether right now we have the right targeted tools. So we've used general tools and we've used them effectively, but yes, how we actually are able to regulate the existing distribution system within insurance, there is an open question that we're talking to with industry players, the CLHIA, about what is the right model for regulating. Other provinces have started to regulate MGAs, for example, as a special class of registrant, whereas we in Ontario right now just treat them as another form of corporate agency, which could be a very small organization or could be a very sizable with hundreds or thousands of agents in those tiered models underneath.
Okay, so really some really important insights, of course, and I want to make sure that there's enough time for questions from the group, but let me ask a few others and then we'll pause for questions from the group and we'll see where we're at. So let's turn to segregated funds and deferred sales charges. You and FSRA and other insurance regulators across Canada, I think, are sending a pretty clear message that it's time to stop deferred sales charges sales and to have a broader conversation about how to ensure consumers are being treated fairly. And it was mentioned earlier that FSRA is proposing 2 separate amendments to the Unfair or Deceptive Acts or Practices UDAP rule. And so if approved, these proposed amendments would ban sales of new individual segregated fund contracts with deferred sales charges after or effective, I think, June 2023. And so do you feel this is enough for Ontario consumers?
Yeah, the banning of deferred sales charges, I think, is an important step. We have good support from the large majority of industry for ending this practice. It's been banned already on mutual funds, and so that is an analogous product. And so there should be some similarity in how the mutual fund and segregated fund marketplaces work. And I'm comfortable that the way we're going to ban them, which is prospective, but also recognizing that existing contracts with deferred sales charges, some consumers with appropriate disclosures may decide that because those terms are advantageous to them, that they wish to keep them. And so I think we're finding the right balance here of keeping the marketplace functioning, allowing consumers to continue to invest through segregated funds, because it's an important tool that adds insurance advantages to mutual funds. And it is a bigger question, generally about how incentives are paid, but on the deferred sales charges, I think we and the CCIR and the CSA on mutual funds are in the right place.
Okay, terrific, thank you. Let's see if there are any questions on the floor. And if there aren't, I've certainly got a long list, but I would welcome questions from participants, and we just need to get you a mic.
Right, we're just going to get a microphone. So to the people that are now online.
Hello, online.
The online participants, please email your questions to FISRA, exchange@FISRA. We'll say them out loud. And we apologize for the fact that we have two staff with microphones.
And Judy, how much time do we have for?
You have till 10:15.
Okay, thank you.
Okay. Thank you very much. My name is Anthony Grande. I would like to express my sincerest gratitude for the opportunity to speak and ask a question. I extend my appreciation to the ministers who were supposed to be here, Honorable Minister Bethan Falvey, who actually provided a video message, as well as Ms. De Laurentiis and Mr. White, so thank you. And as a regulated health professional and business owner, I am one of many individuals with advanced degrees, MBAs, doctorates, actual doctors, who provide vital services to those who have been injured in car accidents. And I'll make a statement and I have a question. So it is concerning that FISRA, a publicly funded regulator, made a profit of $10.4 million last year. Additionally, the number of employees on the Sunshine List at FISRA has increased from 73 in 2013, when it was fiscal, to 248 in 2022. And salaries are rising every year. Probably well-deserved, that's not the issue. As a regulator and licensor of regulated health professionals, FISRA does not employ any regulated health professionals, which raises questions about the organization's commitment to upholding industry standards. FISRA does have a committee named the Health Services Provider Advisory Committee. And the majority of the members of the 2021 FISRA Health Services Provider Advisory Committee resigned, citing a feeling of being given lip service, to put it mildly. As a result of the resignations, the new composition of the committee had a change of mandate and now consists primarily of insurance company representatives and insurance examination representatives, which raises concerns about FISRA prioritizing the interests of insurance companies over those of health service providers, the small business economy, and the public. Now, FISRA's actions have led to negative impact on the healthcare industry, and you might not be aware of this. The fees paid to FISRA since licensing began could have paid for 1,653,420 patient visits since the beginning of licensing, up to March 31st, 2021, and this continues to grow. Yes, there is, thank you. I only have one chance to speak. There will be one. The health service provider industry has paid $27,557,000 in fees for redundant regulation up to March 31st, 2021, and lost an additional $300,000 in additional treatment sessions due to the administration. The total cost per year to the health service provider industry due to the red tape is $72 million, with a total cost up to March 31st, 2021 of $504 million. Furthermore, FISRA's yearly, here's the
if we could just shorten it, just because I want to make sure that, of course, Mark gets an opportunity to answer your
benefits
question.
Indexation calculations resulted in a 444% adjusted cost improvement for liability since 1996, benefiting auto insurers, while fees for professional services controlled by FSRA have been reduced by 18% on a dollar-per-dollar basis since 1999. But when we adjust for inflation, the fees have been reduced by 50% to service providers.
No. Can I suggest you submit those numbers to us, and what is your question, please?
So these actions are creating a number of significant problems. My mic seems to be turned off. Hello?
No, it's not.
Okay, sorry about that. It's my voice. Including reduced access to care, decreased quality of care, financial strain on service providers, and a negative impact on publicly funded health care. And in the end, it reflects poorly on the political leaders that you serve. So this is my question, and I'll get ahead. I'll jump ahead, and I'm sorry if this is emotional for me. Okay. In the room, so I just want to point out one thing. I am being earnest when I say that health service providers often face a heavy administrative burden. The stack of papers here is 70 pages, and this is the manual to submit an invoice to an auto insurer. That's a lot of red tape. And here's my question, and thank you for giving me the opportunity. Why did the Financial Services Regulatory Authority provide discounts to some of the sectors it regulates, as stated in the 2021 FSRA annual report on page 43, but not to health service providers, who were mandated to shut down for 3 months during the COVID-19 pandemic? Why were those same clinics that were shut down for in-person care targeted for audits for providing virtual care as the only means of survival? And can you also specify which sectors specifically received the discounts, and how does this align or not align with the principle of impartiality and fairness expected of a regulator? Thank you for your time.
First, well, your question has many aspects to us. FSRA, of course, has the greatest of concern for accident victims as well as any other consumer. There are numerous facts which you put into your question, which we're just going to have to look at. I will say there are some facts which are just incorrect. We're not funded by the taxpayers. We're funded by the regulated sectors. The health service provider sector actually, generally in most years since we've been in business, has not actually covered its cost, and the auto insurers cover it. And there is a very fundamental misconception that we actually regulate health service providers in the provision of health services. We only regulate health service providers when they choose voluntarily to be part of a billing system called HCI is the acronym. I won't get into the details. And so it is very important that FSRA focuses on the regulation of the sectors and our regulatory duties. The fees that are paid to health service providers are not part of the FSRA mandate to set. They're not subject to our review. And there has been, with the health service providers, sometimes confusion that they think they have a stakeholder advisory committee as a window to deal with their issues with the auto insurers, whereas they have a stakeholder advisory committee because they are a regulated sector as to their billing practices. And so we continue to be focused on making sure that the billing practices are fair and that there is no fraud in the system, or you can't get no fraud in the system, but we're working towards that goal.
Thank you. Thank you for your question, and thank you, Mark. I have some questions on pensions that I want to make sure that we that you have a chance to address, because I think many will want to hear about this. Now, again, going back to the Auditor General, made a number of observations about FSRA's oversight of pensions. And so in the federally or in the provincially registered pension plan sector, seems that members have not been adequately protected, one could say, in multi-employer pension plans from the risk of significant and permanent reduction of targeted pension benefits. And FSRA and the ministry, again, one could argue, are not ensuring that pension plan administrators are transparent with their members about the fact that these pension benefits can be reduced at any time. And so, in your opinion, is this fair? Are you concerned? Should it be fixed?
So multi-employer pension plans set a target benefit, and there are great advantages. So these are, for example, trade union plans. and because they allow for aggregation of savings, professional management, pooling of mortality risks, so there's great advantages to them. But it is a pooling of money that is a set pot, much like your defined contribution pension might be. And so, yes, it does happen that the target benefit has to be reset. Our view is that it happens with too much frequency, and we have taken very important action. First time we benchmarked MEP practices in governance and disclosure, and we're actually now, after we put out best practices, we're now actively supervising against those. So we think we've actually taken some very important actions, but it is important to understand that the flexibility of the benefits is not a flaw, it's a design feature. And we do hope that multi-employer pension plans make that clear to their members that they are subject to investment, mortality, and other risks, because it is a pooling of money rather than a defined benefit.
Okay, Mark, when I think about pension plans in this country, I also think about them investing in crypto based on newspaper headlines that I've been reading. And back in November, the Ontario Teachers Pension Plan wrote off $95 million US following the failed investment in FTX. And so the UK regulator reaffirmed the need for UK pension plans to maintain, kind of good cash buffers to kind of address yield rises and, kind of put out guidance on liability-driven kind of investment strategies. So what do you see as kind of the investment risks in our pension plans, and what is, kind of what are your expectations in terms of management, kind of pension management obligations, reprudent investments, pension board oversight in relation to investment risk?
Our large pensions in Ontario, and they're sizable, $500 billion, are very important. They have so many members and they have so much economic clout, and if there are problems there, it will really matter. And we believe that part of our mandate is making sure that there is good administration and rights and benefits are protected. It's right in our statutory objects. And so we've taken important measures already, working with these large joint-sponsored public sector plans on things like liquidity risk, which the liability-driven investment issue in the UK was a liquidity issue essentially, and looking at alternative investments, those more opaque non-public investments which don't mark to market. And we're now actually focusing on investment risk management and governance, because these are sophisticated, complicated organizations. And so I am less concerned about individual mistakes like FTX, and there was an OMERS issue in 2020, and there was a bigger AIMCO issue in Alberta, and we learn from those. And that's what I really want to focus on, is that if you have good governance and controls and processes within those organizations, checks and balances and oversight, then I'm comfortable that with their large diversified portfolio that the investments will be safe. And they all have different strategies. And so what we're working on is making sure that they have those processes in place. And I think that's a real value add, but I don't think that because there is the odd investment where maybe a mistake was made, maybe due diligence wasn't good enough, learn from that. And we're going to make sure those lessons that happen at one plan will be learned by the rest of the sector as well.
Okay, fair. Two questions before we open it up to the participants again. So one is on the consumer office, which I think as a regulator is rather unique, and it seems innovative and insightful, but kind of how does it actually change the way that FSRA operates? What sort of input, insights do you receive from the consumer office that then affects your policies and your decisions? And I think related to that, different though related, is kind of the innovation office. So, how does the innovation office support the work you do? And how do you also make sure that the innovation office kind of finally balances the interests of consumers and the public interest with, thinking about kind of businesses that you regulate, their bottom line and kind of, their interests?
So, right from the board that I have, which gives me input into how to structure ourselves, we looked at what are the difficult things for regulators to do well. It's very difficult, even though the consumers are the most important part of our mandate and we give that prioritization, we spend almost all of our time talking to the regulated entities. And so we needed to find a way to get those diverse consumer voices heard. And so we created the consumer office. And with the consumer office, we created the consumer advisory panel. And both of those, the consumer office acts as a secretariat to them. The consumer office acts as an advocate internally, so that when we're developing new supervisory frameworks or policies or guidance, we hear that consumer voice. And the consumer advisor panel then gives us a tool, essentially experts, independent, who basically volunteer their time. They maybe get some expenses covered. And I meet with them, I personally meet with them, as well as our teams meet with them on individuals' issues. And they've given us input on complaints processes, whistleblowing, financial advisor, financial protection, mortgage services, insurance distribution. And so it is invaluable for us to hear those other perspectives. And the consumer office is one of the ways we do that, in addition to those stakeholder advisory committees. And the innovation office, again, very difficult for regulators to be innovators because we actually have to play defense to protect consumers. And so we've created a dynamic within our organization, and we have a framework of innovation, and we've been given exemptive powers, and we've talked about barriers in different areas to innovation. So in mortgage brokers and insurance will be out soon. And so our goal is to use that innovation office so that innovation ideas don't die when the frontline supervisor says, no, that's not how we do things, that's never been done before. We want to look at innovation to see if it's in the public interest. And choice is a very important part of it, and also taking a longer term perspective. And so if you don't allow innovation to flourish, the Ontario economy will be hurt, consumers will not get the products and services they want, and they won't be able to consume them in the way they want to consume them. And so we want to use test and learn environments to trial new innovative ideas. And there's a broad spectrum of things we're hearing about. So I'm very pleased with both the consumer office and our ability to support innovation.
Thank you, Mark. Any other questions from the floor? Over there, we'll send you a mic. And if you could identify yourself, that would be great too.
Hey, good morning, and thank you for the opportunity to ask you a question. My name is Erin McKee. I'm the 2023 IAC chair. I'm also on FSRA's technical advisory committee. There are over 1 million orphaned life insurance contracts in Canada held at MGAs and national accounts, with service fees still being paid out to those distribution partners. As well, commissions, small they might be, are still being paid out to individuals who've either lapsed their license, retired, even in some provinces they've passed away and their commissions are being paid to an estate. What is FSRA doing to help guide the industry to ensure that consumers are serviced for the contracts that they've purchased? Thank you.
Well, thank you. That's a great question. I'm not going to be able to answer the detail on particularly lapsed insurance contracts where the agent's no longer providing the service, but the fees are being paid. But let me deal with that on a more generalized basis, because I think there's an important consumer protection issue here. You want consumers to get advice, because insurance, particularly life insurance, particularly if it has investment elephants and its whole life, universal life, those are complex products. And so people need to get that advice. And so we want to see that agents provide that advice, because that's how the insurers will, get to market and get the right products to them. But there is a balancing. It goes back to the deferred sales commission discussion, and it goes back to upfront fees versus trailer fees. And you have to look at these different models, and there is an ongoing consultation, just finished, that FSRA is part of through the CCIR, where we're looking at what is the right mix of upfront compensation, what is the right model, should there be chargebacks, when should commissions stop, and how do you, but at the root of it all, and this is really to your point, we have to make sure that the services continue to be provided. And so you've raised an issue that fees are being paid and services are not being received. So that's something we'll look into.
Thank you.
Great. I'm just going to jump on the stage for our 800 people online. Once again, our apologies. We also want to hear from the online participants. So once again, please email at fisraexchange@fisra.ca. And what we will do is read your question out in this room, in addition to the people that are present. So thank you, online audience. Please feel free to email your questions in. Sorry for the interruption.
Thank you, Judy. Any other questions?
Any sectors we haven't talked about, Poonam?
Yep. Oh, tons. I can go back.
We have a lot of sectors to regulate.
I was trying to be to make sure that questions were that we had time for questions from the floor. So let me ask in relation to mortgages. So you've introduced new licensing requirements for mortgage brokers and agents who arrange private mortgages. And so, Ontario is the only jurisdiction doing this. So is this because there's people that are not qualified. Are they bad for or private mortgages bad for consumers? What's the thinking behind this?
Well, getting that house purchase, and you need the financing for it, unless you're a very, very small percentage of the population, is really important. And so getting advice and getting access to that money is really important. So people use mortgage brokers because this is complicated, and it could be the first time you'll ever do something like that. Even the second time, I've done it 3 times, and it never really gets easier. So private lending, though, happens in a variety of circumstances, but the main one is the more difficult it is to get a mortgage from a traditional bank or financial institution, the more you need to go to private sources. And so, as you tighten down in OSFI, for example, with its stress test rules, as they tighten those down, and as interest rates go up, and people can't qualify, they're being forced to look for alternate sources. So private lending fills a very important need. And there's 2 ends to the private lending transaction. There's an investor as well as a borrower. And so these are more complicated transactions, and we want to make sure that those investors and borrowers are well served through the process. And particularly the borrowers need to make sure they understand what they're getting into, because they're often higher rate, shorter duration, less certainty on renewals. So there is additional risk with them. And so the suitability is very important. And we're using this as a tool, yes, not only to make sure that private lenders, that we have broad support from mortgage brokerages across Ontario, and we think it may be picked up across the country, because they realize that it takes additional expertise. You don't want someone who's a rookie mortgage agent having to deal with not only identifying what's good for the borrower, but then you have to negotiate with the private lenders on the other side. So we think we're doing the right thing on that. It's part of the whole figuring out what is suitability for an individual, making sure there's disclosure of that, and increased professionalism is something that we've seen in the mortgage brokerage industry. For example, at our request, they've adopted a nationwide code of conduct for the first time. So we're seeing all the right things with that, and I think the private lending is the right thing. They're not bad in and of themselves, but they can be bad either for the borrower or the investor if there's not a good job done.
Okay, there's also been a lot of attention paid to syndicated mortgages, and we've seen some kind of changes in terms of regulatory oversight in Ontario. But what is kind of FSRA's role in relation to syndicated mortgage investments? What are you doing to, again, ensure that consumers are being protected, but at the same time kind of allowing this sort of investment to be out there?
On the syndicated mortgages, and Fortress may be in people's minds, the issue that it's not the borrower, it's actually the investors. And so these are higher risk and higher yield investments that were sold to investors. And the issues relate to the disclosures and the suitability, and then to the mortgage administration, because if many of them are development projects. And so if they don't get developed, and let's face it, we're going into, it's a bit rocky already for real estate, and it may be a recession. So a lot of those projects may never get developed or would have to sit around for a while. And so there's going to be more problems here. And so we've created a process to not only, first of all, engage with the OSC, where it's retail investors and not sophisticated investors, where they're actually now more treated as a security, although we still regulate the mortgage brokerage activities. But we've also created information flows, used that information. It's a great example of risk-based supervision, where we got information, we've now assessed it. And there's one example I have in my mind where it wasn't as big as Fortress, but it was still in the hundreds of millions of dollars of essentially commercial real estate development, syndicated mortgages, and those properties weren't getting developed. And so we've actually used our tools. These things don't tend to hit the headlines because people are with either full payouts or very small haircuts. We're actually making them work the portfolio. They've been very cooperative. And so that's the type of regulation you want to see, where you're proactive and you're helping where people do get into a bad investment, where you're leveling the playing field and making sure that a mortgage administrator has oversight, that there's parameters, and that they're making sure the investors get the best possible deal they can.
Okay, I've got one question on financial planners and advisors, another area that you regulate, and then we'll wrap up because we are running out of time. So, you launched a new titling framework for financial advisors and planners. And so should consumers be noticing a difference right now? Has the situation improved? I know there's lots of different views about how to regulate in this area, but would welcome your kind of thoughts on what you are doing and what consumers can kind of expect to see in terms of changes in the framework.
Well, there's no doubt in my mind that this is a long-awaited, decades-old problem consumers always assumed that if someone used a title like financial advisor or financial planner, that it meant something, that there were minimum standards, there was education, there was oversight, there was complaints, there could be discipline. And frankly, there wasn't any of that. And so, yeah, it's a much better situation for consumers today, but it is still, going back to that work in progress, we're in a transition period where people are grandfathered. So there are people who are using it who might not be subject to those things. And that's, 2 years for financial advisors, for example. And so I really look forward to when we're fully implemented at the end of the transition periods. And I am confident that the credentialing bodies that we're approving, after extensive public consultations, meet or are on the path to meeting those requirements of minimum standards to make sure that financial advisors, financial planners, those who use that title when this is implemented, that it will have true meaning. And we're still talking to other potential credentialing bodies, as well as dealing with the finishing pieces of the framework about information exchange, getting the public registry in place. And there is also a question out there about, well, should the new SRO come in? And yeah, we're talking to the new SRO, just like we're talking to other potential credentialing bodies. Because the broader the scope, so that there's the most consistency in the use of titles, will remove consumer confusion. And so a lot, right now, investment advisor is not considered to be confusing to financial advisor. And so, we'll see how the marketplace develops about that. But the ideal world would be that everybody would start to get together in using the same titles, and consumers can know what they mean. And we have a public education program so that people will really start to realize that financial advisor, financial planner, it means something and you can rely on it.
Okay, so my last question for you. The Auditor General has said that FSRA is a work in progress, and I've referred to the Auditor General's commentary a bunch of times today. So what can we expect in the next year? What can we expect in the next 5 years?
Well, I'm a work in progress, and I hope I always will be until the day I die. So I don't think it's a bad thing to be a work in progress. And what I think people can expect is that we're going to continue our focus on the consumer, on the public. And that's both a short-term focus, and you've heard me talk about innovation and balancing. It's also a long-term focus to make sure that there's also strong, sustainable, competitive, and innovative financial services and products. And we are going to work on that balance. And you're going to continue to see across all the sectors that we view this as something that it is an ecosystem, and we help manage the ecosystem, but we can only be as strong as all the players in the ecosystem. And that's the regulated entities, their boards, their senior management, their processes and controls. It's also the stakeholders, the consumers we talk to, and that's why we do the outreach. It's government, it's other regulators as these things cut across borders. And so you're going to see more of the same, but you're going to see that we're building on the foundations we've built, and those are strong foundations. We are building, and you're going to hear about it through the rest of the seminar today. You're going to hear about some of those foundations. You're going to hear about we have the place to continue to grow and continue to build. And we have the people. We've got hundreds of new people within a 550-person organization, but we're building a culture of effective regulation where we're caring about what we get for the consumer, for the public. That's our end goal, is making sure that they're well served. And so I'm very excited about what we have in the next year and what we have in the next 5 years.
Thank you very much, Mark, for the conversation today, and thank you, all of you.
Thank you, Poonam.